Hey, what's up guys? Welcome back to the channel. My name is Frank Mularcik, and in this video, we're going to be talking about the top 3 ETFs that you can invest in for the long term to grow your wealth. So even though I talk a lot about stocks on this channel and other strategies such as options as well, the majority of my investments, I would say 50 to 75%, if not maybe even a little bit more, the majority there are all invested just in some ETFs, just two main ones, and then I'm going to throw in a third that we're going to talk about as well. So personally, I'm a fan of ETFs just because they're super easy to use oftentimes, and you can get a pretty low expense ratio with some of the ones I'm going to show you today. And you really just don't have to put a whole lot of time into it, and you can still get, pretty good returns a lot of the time. So the first one we're going to look at here is ticker symbol VOO, and it's the Vanguard S&P 500 ETF. And if we just look at the summary here, it says it invests in stocks in the S&P 500 index, which represents 500 of the largest U.S. companies. The goal is to closely track the index's return, which is considered a gauge of overall U.S. stock returns. It offers high potential for investment growth, but the share value rises and falls more sharply than that of funds holding bonds, which is definitely true. And it says it's more appropriate for long-term goals where your money's growth is essential. And it gives it a risk potential and reward, rating of 4 out of 5, which means in their eyes it's pretty risky. To me personally, I don't think it's that risky, but you can definitely go with safer investments if you want, such as bonds. But just taking a look here, the expense ratio is 0.03%, which is pretty awesome because that's basically 3 cents out of every $1,000 per year that you invest or that you have invested. And then down here, they talk about the diversification, so just across the sectors, and what the benchmarks are. So communication 11.1%, consumer discretionary 12.1%, consumer staples 6%, energy 2.8%, financials 11.9%, healthcare 13%, industrials 8.9%, infotech 26.2%, materials 2.8%, and then real estate and utilities are at 2.6% each. So those are, the weightings across the different sectors. And then we look here, we can see the 10 largest holdings: Apple, Microsoft, Alphabet, Amazon, Facebook, Berkshire Hathaway, JP Morgan, Tesla, Johnson & Johnson, and Nvidia. So those are all great companies and great companies to own in this ETF. And then at the end, we're also going to, compare the returns of this versus the others, but we're going to move on right now to the second one, which is VTI, and that's Vanguard's total stock market ETF. And it seeks to track the performance of the U.S. total market index, and it not only has large cap stocks, but it has large, mid, and small cap equity diversified across growth and value styles. It employs a passively managed index sampling strategy, and it remains fully invested with a low expense ratio, as you can see again, 0.03%, and they give it a risk potential of 4 once again. And then similarly, it should have, pretty similar sector allocations. So materials 2.2%, consumer discretionary 15.9%. I think that's a little higher than VOO. Consumer staples is 4.9%, which is a little lower than VOO. Energy 2.8%, financials 12%, healthcare 13%, industrials 14.3%, real estate 3.5%, technology 25.5%, telecommunications 3.1%, and utilities 2.8%. And we can see the top 10 holdings are pretty similar here. Microsoft, Apple, Alphabet, Amazon, Facebook, Berkshire Hathaway, JP Morgan, Tesla, Johnson & Johnson, and United Health Group. So that's that for that one. We'll look at the returns a little bit later. And then the third one we're going to take a look at is called VGT, and it's Vanguard's Information Technology ETF. So it's basically invested only in technology companies. So it seeks to track the performance of a benchmark index that measures the investment return of stocks in the information technology sector. It's passively managed using a full replication strategy when possible and a sampling strategy if regulatory constraints dictate. It includes stocks of companies that serve the electronics and computer industries or that manufacture products based on the latest applied science. So this one does have a slightly higher expense ratio of 0.1%, but that's still, significantly lower than the vast majority of ETFs and mutual funds and index funds. And by the way, all these, at least Vanguard ETFs, they're available in a mutual fund But to me, there's really not much advantage of the mutual fund, and oftentimes they have, investment minimums, so there's really not much point in doing the mutual fund, but it really doesn't matter as well. You can do either one of them, and they usually have right about the same expense ratio. And then they break it down here into the actual different industries within the technology sector. So application software 13.3%, communications equipment 3.1%, data processing and outsourced services 14%, electronic components 0.9%, electronic equipment and instruments 1.2%, electronic manufacturing services 0.8%, internet services and infrastructure 1.5%, IT consulting and other services 3.8%, semiconductor equipment 3.5%, semiconductors 16.2%, system software 20.7%, technology distributors 0.4%, and technology hardware storage and periphery is 20.6%. So those are the weightings of those different industries. And then if we look here, the holdings, the top 10, Apple, Microsoft, Nvidia, Visa, MasterCard, PayPal, Adobe, Intel, Cisco, and Salesforce. I really like the Salesforce in there because I feel like it's not as high up in some of the other index funds that we talked about, like VOO and VTI, but you get some good exposure to Salesforce, which is a super great company in my opinion, and so are all of these. So that was just a brief overview of those three index funds, and we're going to look at the returns compared to each other right here. So basically, I like all of them mainly because they invest in a broad variety of stocks, and they have low index or low expense ratios, that is, and they're also just managed by Vanguard, which is one of the best companies for managing that kind of thing out there. So first, we're going to compare VOO and VGT. So it's going to go back as far as they go, which is back to around 2010. So the annual return for VOO was about 15.4% on average, and VGT was 21.4% over that span of around 11 years. So VGT definitely outperformed there, but as many people probably know, technology has just been on fire. So it's important to note that that's could probably not sustain itself forever. So that's probably not going to be the case forever. It could be for a long time, and it could continue. VGT could continue to outperform. It could continue to outperform forever, but you never really know. And so oftentimes I like having a little bit more diversification than just technology. And then if we compare VTI with VGT, you're going to see the returns from VTI and VGT, or VTI and VOO, are very similar, just because it's just how it works. Like VTI is mostly contains what is in VOO. So we're going to look at that as well in a minute. There's a website you can compare the holdings of an ETF, and it kind of shows you the overlap. So we're going to look at that as well. So this one actually starts in 2004. I'm not sure why the other one wasn't. I guess VOO hasn't been around as long, but this one starts in 2004. And since 2004, VTI has performed 10.49% and VGT has performed 13.81%. So we definitely saw some more of a recession with the crash of 2008. Sort of have an effect there as well, but so they're a little bit closer than VOO and VGT, but you can see there that VGT is still outperforming, but both are still doing very well. And then finally, just comparing VTI to VOO, we can see the returns are very similar, with VTI at 15.51% and VOO at 15.44% since 2010. So pretty much the exact same thing there. You're not going to have much of a difference. If you invested $10,000, you would have about $300 difference of $47,212 versus $46,905. So $300 over the course of 11 years is not that big of a deal, but it certainly helps to get the little bit extra percent, but in my opinion, it's not that big of a deal. Okay, so now we're on this website called etfrc.com, and what you can do is you can look at how much these funds overlap. So we're going to put in VOO, and then we're going to put in VTI, and we're going to find the overlap. And it'll take a second to load. And basically, it says that 99.6% of VOO's holdings are also in VTI, which makes sense because pretty much VOO is all of the top 500 companies, and then VTI is all of the companies in the US that are publicly traded. So, you would expect pretty much all of VOO to be within VTI. And then we can say 13.8% of VTI's holdings are in VOO. So the one thing I would want to look at is to try to maybe compare the weighting, because this is just looking at the number of stocks, this 13.8%. So maybe, this is the weighting right here. So I guess 82% overlap by weighting. So I think that's just interesting to see. And, as we looked at in the returns and in this little website here, VOO and VTI are, pretty similar. So it's not that big of a deal. So now we're going to look at VGT versus VTI. And we're going to find the overlap there. We can see 98% of VGT's holdings are in VTI, which makes sense. But it says only 9.5% of VTI's holdings are also in VGT. So, and that's a 26% overlap by weight. So that's just something interesting to look at, that, you really don't need to hold VOO or VTI. I personally do, just because, that's what happened, I guess. But I also own a little bit of VGT. I like that one as well. And there is another ETF that I might recommend as well. It's VUG, and that one is, a more growth-focused ETF like VGT, but it doesn't have, it's not solely focused on the information technology sector. It has some other sectors throughout. Actually, let's just look at it right now. And you can see that, as we'll look, that it's still, a vast majority of it is the technology sector. So we can see it seeks to track the performance of the U.S. Large Cap Growth Index, expense ratio 0.04%, which is really low. But if we look here at the sectors, we can see that technology is 46.6%. So by far the biggest sector is technology in this ETF, and then the other one is consumer discretionary. That's pretty big. But it's important to note that there are, a decent amount of other companies and other sectors in there that give you some more diversification while still focusing heavily on growth. So let me know if you guys do own any of these ETFs, or all of them maybe. These are definitely ETFs for people that are, working probably and trying to build their wealth over time. I would say there's some other ETFs that are pretty good for people that, have accumulated their wealth and are just trying to preserve it over time. And I have not, made any videos on those in the past, but I'll leave a link up here to Jerry's channel at GWETF channel. He makes a lot of videos on ETFs and talks about some more ETFs that are more focused for people that are looking to retire and just kind of preserve their wealth rather than continue building it aggressively. So I'll leave a link up there. I want to thank you guys for checking out the video. I really appreciate it, and I will see you in the next one.